Welcome to The Explainer. Okay, today we're setting up the ultimate battle between two completely opposite investing strategies. Just imagine for a second that you are the unluckiest investor on planet Earth. Every single time you have cash ready to invest, you wait and you wait until the stock market hits an absolute all-time high. Then, and literally only then, do you finally buy in. You don't buy a single dip, you just buy peak after peak after peak. You'd probably assume this person is completely doomed, right? I mean, they're the ultimate poster child for buy high, sell low. But hold that thought, because the reality is going to completely change how you view your money.
Okay, let's dive into this and introduce our two hypothetical investors side by side. On the left, we've got our unlucky investor, the one who seemingly has the worst timing in financial history, exclusively buying at absolute all-time highs. And on the right, we have the patient investor. Now, this investor is cautious. She absolutely refuses to buy when markets feel expensive or overheated. Instead, she waits patiently on the sidelines for a definitive 10% dip in the market before she puts a single dollar to work.
So, looking at these two contrasting methods, one that feels super reckless and the other that feels totally prudent, we really have to ask who actually wins over the long haul. Is it the investor who buys at the absolute top of the market or the one who safely waits for a discount? Well, the answer goes against almost everything our intuition tells us about risk and reward.
Section 1. The Cost of Waiting, featuring Archbridge Family Office data. Now, what's really interesting about this is when we look at the fascinating research from the Archbridge Family Office, who analyzed S&P 500 returns all the way back to 1990. They compared waiting for a 10% pullback versus just investing immediately at an all-time high. And the results? They're stunning. The average returns for investing at all-time highs are noticeably higher. Yeah, you heard that right. The seemingly doomed, unluckiest investor who buys at the absolute peak actually outperforms the patient investor who is waiting around for a 10% dip. You're probably thinking, how does this happen? How can buying high actually win? Well, it's because all-time highs don't just happen in a vacuum. They cluster together. Think about it. Healthy markets don't just hit one single peak and instantly collapse. They hit dozens of peaks in a row. This clustering happens during strong bull markets, periods of robust economic expansions, and times of massive investment flows. Basically, when the economy is growing, the market naturally pushes to new heights again and again.
And that brings us to an absolutely critical concept: opportunity cost. This is the potential profit you lose while you're just sitting in cash, waiting for that perfect entry point. While you're on the sidelines waiting for a 10% dip, the market is just continuing to climb upward. The brutal reality here is that by the time a 10% correction finally arrives, prices are often still higher than they were when you first started waiting. You completely missed out on all the growth that happened in the meantime, and that lost growth, that's your opportunity cost.
Section 2. Missing the best days and the danger of sideline sitting. But guys, the penalty for sitting on the sidelines gets even more severe. Waiting for the perfect moment doesn't just cost you the gradual climb. It can actually cause you to miss out on the most explosive days of wealth creation. There's this staggering study by Hartford Funds looking over a 20-year period. If you missed just the 10 best days over 2 decades, your total returns were cut by more than half compared to the baseline. Miss the 20 best days, your returns are slashed by over 70%. Seriously, think about that. Missing just 20 days out of 2 entire decades destroys nearly 3/4 of your wealth. No way, right? But it's true.
And here is the truly cruel irony of the whole shebang. Guess when those best days usually happen? They almost never happen when the sky is clear and the news is perfectly positive. The best days happen right in the middle of market volatility. They occur right after a crash, when fear is at its absolute peak. If you're sitting on the sidelines waiting for clarity before you invest, you are inevitably going to miss the recovery entirely. Because that recovery happens fast, and it happens exactly when it feels the most dangerous to jump in.
Okay, let's take a quick mental breather and simplify this. Think of investing like planting a tree. Does it really matter if you plant that tree on the cloudiest day of the year or the sunniest day of the year? No, of course not. What actually matters is that you planted it, and you gave it decades to grow. Time in the ground is what builds the tree, just like time in the market is what builds your wealth.
Section 3. The Hidden Concentration Catch. Time to look under the hood.
So, the crucial point is, before you take all of this as a sign to blindly dump all your cash into a standard U.S. index fund, you need to know about a hidden concentration risk. The number you absolutely need to understand is 41%. That is the sheer, overwhelming weight of technology stocks in the S&P 500 today. It is a massive, dominant block. According to data from Rockefeller Capital Management, this 41% allocation to tech is a level of concentration we literally haven't seen since the dot-com bubble. Nearly half of the entire index is being driven by a single sector. The other 59%? Well, that's spread across literally every other industry combined: healthcare, finance, energy, consumer goods, you name it.
What this actually means is that when you buy a standard index fund today, you're kind of under an illusion if you think you're making 500 equal bets. You aren't. You are making a massive, outsized bet on a handful of mega-cap tech giants. If those specific tech companies stumble, the entire index drops with them, regardless of how well the rest of the economy is doing. It's a risk you absolutely must be aware of when you buy the market.
Section 4, Consistency Beats Perfection, the Ultimate Strategy.
And this brilliantly illustrates our core lesson: consistency beats perfection. Waiting for a dip costs you dearly. Missing the best days absolutely destroys your wealth. And buying the whole market means taking on heavy tech concentration. So, where does that leave us? Trying to find that perfect sunny day to plant your tree is a losing game. The data clearly shows that regularly investing a fixed amount, whether the market is up, down, or at an all-time high, is what actually wins. Consistent action beats paralyzed perfectionism every single time.
I want to leave you with this final thought. Take a hard look at your own strategy right